Hey everyone, and welcome back to another innovative investment idea. My name is Dave, and in today's video, we'll be taking a look at NIO, a Chinese electric vehicle manufacturer, to dissect the stock's recent price run-up and what its potential value might ultimately be in the long run. Make sure to stay tuned until the very end, as I'll be going through some specific company news and analysis before finally giving my thoughts on whether the stock is a buy at the current price. Also, just a friendly reminder to hit the like button at the end if you enjoyed the video, and to hit the subscribe button if you're new to the channel, since each one takes a fair amount of time to produce and I'd really appreciate the support. So with all that said, let's dive right in. For those not yet familiar with NIO, ticker symbol November India Oscar, it is a Chinese company headquartered in Shanghai and competes within the electric vehicle segment, which has clearly been front and center in recent times thanks largely to the high profile of Tesla and Elon Musk. Aside from concept cars in the EP9 model we saw during the introduction, it currently engages in the mass manufacture of only SUV class electric vehicles, notably its flagship full-size ES8 model, which it launched in 2018, and more recently the mid-size ES6, which seats 5 passengers compared to the 7 in the ES8. It is also on the cusp of rolling out the EC6 model, a crossover SUV even more compact than the ES6, which it launched in direct response to the Tesla Model Y. So what differentiates NIO then to other players in the space from both the consumer and investor perspective? Well, there are 4 key factors in my opinion, and let's quickly go over them before turning our attention to the company's stock price. So number 1, NIO's range of products are currently only available in China and not yet in the US or Europe, as it has chosen to focus on its home market exclusively instead of spreading itself too thin. Fortunately, China currently accounts for more than 50% of the global EV market, so that decision still makes economic sense, and NIO can leverage their knowledge of the local landscape and focus on ramping up production as they continue to strengthen their brand and reputation. Number 2, NIO vehicles are relatively cheap when compared to others in the same space. For example, the NIO ES8 is priced at 450,000 yuan, roughly $65,000, while the Tesla Model X, a smaller SUV in fact, goes for about 836,000 yuan locally, or $125,000, essentially half the price. In fact, because of NIO's pricing strategy to undercut the competition, in conjunction with the government subsidy incentives to reduce emissions, even Tesla has had to react in recent times, trimming prices across the board to remain more competitive as the EV market heats up in China. Number 3, it has fully embraced the philosophy of battery replacement ahead of traditional charging, a move that even Tesla attempted initially during the Model S rollout but quickly backpedaled on. For a small monthly subscription fee, NIO owners are able to roll into one of nearly 150 battery swap locations in and around 58 Chinese cities and receive a completely new battery in under 3 minutes. NIO plans to build up its network to over 1,000 locations in the future, and the clear benefit is that owners won't need to worry about battery degradation over time, often associated with lithium-ion cells, or waiting potentially 10 plus hours for a full charge. All of NIO's vehicles operate on standardized and thereby interchangeable battery sizes of either 70 or 84 kilowatt hours, with the 100 kilowatt hour battery pack to arrive shortly. This concept makes a lot of sense, especially in a country such as China, where no one owns land and very few people live in private homes except those way out in rural areas. Within the larger cities, the majority of people live in large apartment buildings, and very few of those have on-site EV charging facilities, and thus it is easy to understand why battery swap is a winning concept. In fact, NIO has now registered 500,000 successful battery swaps, and according to several surveys on consumer sentiment, it's the primary reason a majority of NIO's customers have chosen it ahead of other EV makers. On the flip side, there is certainly some discussion as to whether battery swapping is a viable long-term strategy in Europe or the US, as EVs are steadily increasing their range, easily hitting 200 to 300 miles per charge in most cases, and thereby reducing the need for constant power, and public infrastructure being quite different outside of China. It remains to be seen whether NIO themselves will reconsider if/when they pivot their strategy towards global markets. The fourth and final point, which sets NIO apart from the field, is NOMI, the artificial intelligence unit integrated into the dashboard of every vehicle. Think of it as HAL from 2001: A Space Odyssey, but without the impulse to kill humans.
I'm sorry, Dave. I'm afraid I can't do that.
Currently, it is able to automatically detect the driver's profile to quickly set up custom seat and steering wheel configurations, use machine learning to understand the driver's habits, assist with voiceover commands to bring up navigation, open up windows, play music and games to entertain the kids, and can even take selfies from the roof-mounted camera. I assume the plan is to eventually integrate any future technologies NIO might release with NOMI as well, such as autonomous driving when that eventually arrives, currently slated for 2022. With the growing usage of virtual assistants like Siri, Google Home and Alexa, as well as a general shift towards IoT, it makes a ton of sense for cars to embrace the change, which according to some sources accounts for roughly 19 full workdays of time spent per year for the average American. Now before we get into the current news and events, let's take a quick moment to reflect back on the very start when NIO had its IPO on September 12, 2018 to understand the full picture. Because Tesla had already established itself as essentially the only real player in the EV space at the time, and therefore built a reputation as the manufacturer to beat, it was inevitable that NIO would immediately feel the scrutiny of those comparisons. The Tesla killer, as CNN reports here, would go on to raise $1 billion to fund its operations from the listing at a price of $626 per share, but ultimately fall short of the $1.8 billion target it had originally set out. This was due to a combination of factors, including increased tensions between the US and China as the Trump administration began to escalate the imposition of tariffs between the countries, but also from Tesla themselves as investor confidence waned after a series of failures to meet both earnings and delivery projections, not to mention Elon Musk's infamous 420 funding secure tweet only a month prior, hurting overall credibility of the EV sector. If the first day of trading for NIO proved to be unspectacular, Day 2 would set the world ablaze when it hit almost $12 per share, or rising by as much as 92% intraday to end up closing 75 percentage points above the open. The excitement was short-lived, however, and the stock would not carry that momentum forward, instead taking investors on a roller coaster ride leading all the way up to March 2019, when it peaked above $10 again after reporting 8,000 cars sold. The deliveries were certainly a decent amount considering the company's relatively young age, and a solid step up from the 3,268 vehicles from its first operating quarter as a public company. Aside from that highlight though, the rest of the picture would not be as pretty, as it would consistently underwhelm both analysts and investors alike with its low delivery and revenue metrics. If we go ahead and plot out the delivery numbers for each quarter, but only to the point where the price action clearly picks up from Q2 2020, it's not too difficult to see why NIO's stock price headed south from the highs during March 2019 to a 52-week low of $1.19 during Q3 2019. We'll get to the specific events of Q2 2020 leading to the huge run-up in price on the right side of the chart in a moment, but in conjunction with the low delivery numbers, the net losses were also mounting for NIO during this period, as the failure to bring in revenue to offset the production and operation costs were weighing heavily on its bottom line. In fact, during Q2 of 2019, the company reported a net loss of 3,286 million yuan, or $480 million US, the equivalent of roughly $6 million a day for the 3-month stretch, the biggest loss it incurred for a quarter since Q4 of 2018 when it lost over $500 million. Bankruptcy was a constant and seemingly imminent threat, which no doubt caused many investors to lose confidence and probably jump ship at some point throughout 2019, as there was no clear path to profitability and the company was digging itself deeper and deeper into a hole. In fact, to put everything into perspective, let's go back to the chart and plot the actual losses broken down by quarter alongside the delivery numbers we previously saw. Most investors are able to overlook a company's net losses in the short term, assuming it is growing revenue between quarters or at least year over year, as a general consensus is that a company can eventually make up the difference once it turns the corner. But for that to be acceptable, the revenue needs to be reflective of the hypergrowth phase and also be sustained for a prolonged period of time until EPS closes in on positive territory. On any sign of a slowdown or a deteriorating rate before that point, growth stocks will often lose their luster, and that's exactly what happened to NIO over the course of the entire period between March 2019 and June 2020. So for example, although Q4 2019's 8,224 units represented a new record high for a single quarter, the market response was lukewarm at best, given that the company still suffered an over $400 million loss, and more importantly, the year-over-year growth when compared to Q4 2018 was essentially zero. One positive aspect though, which is quite noticeable with the numbers laid out in plain sight, is that its losses for Q1 2020 were substantially less than any previous quarter at only 240 million, which might indicate that it is finally bearing the fruit of cost-cutting measures, such as the massive jobs layoffs, but potentially might be hinting at greater efficiency in its production process. But the question now then is why NIO, a company which consistently underperformed through all of 2019 and even Q1 2020 and has accumulated extreme net losses over its entire existence, suddenly experienced an explosive price spike from June 2020. In my estimation, there were actually two major catalysts. The first is related to funding. On April 29, 2020, it was announced that NIO had entered an agreement for approximately $1 billion in additional funding with a consortium led by state-controlled Hefei City Construction and Investment Holding Group. After what seemed like an eternity of constant bankruptcy tensions, NIO had finally found a new lease on life and could go back to focusing on producing cars instead of fighting off creditors and juggling the books. As part of the agreement, NIO would be required to shift part of its business to the Hefei area and collaborate with the consortium on various new initiatives. The funding didn't stop there, however. On July 10th, only a couple of months later, NIO signed a deal with 6 domestic banks for a line of credit worth over 10 billion yuan or $1.5 billion that should all but erase investor concerns about cash flow and liquidity. In fact, after the news was announced, buyers started piling back into the stock in a big way as it saw all-time high volumes in trading. Investors are hoping that NIO can keep plugging away while continuing the cost reduction trend it started in Q1, but even assuming the company falls back to the previous cash burn rates, the funding buys the company a significant amount of time to get their proverbial ducks in a row. As an interesting side note, if we take a look at NIO's funding history from even before the IPO, there are a few eyebrow-raising revelations that also might help investors understand the complete picture. The first thing that leaps off the page is that Scottish fund management firm Baillie Gifford is listed as having invested an undisclosed amount on October 10th, 2018. But in fact, if we dig a little deeper, we discover that SEC filings for Q3 2018 tell us that they had in fact taken up an 11% stake in NIO. If you will recall, the firm is the second largest holder of shares behind only Elon at almost 8% of the company, a position it opened way back in 2013, and investors could interpret that as a bullish signal since Baillie Gifford has clearly established a precedence within the EV segment after having correctly predicted the rise of Tesla from its fledgling and equally unprofitable start. The other worthwhile takeaway are the multiple and substantial investments by Tencent, a major Chinese multinational with interest in a variety of other successful and well-known pursuits, such as Riot Games, the developer of the highly successful League of Legends, which generates more than $1.5 billion annual revenue, WeChat, the world's largest standalone mobile app, and even forays into the music industry, where it owns a significant stake in Spotify. This lends even more credibility towards NIO, since it has not only caught the attention of Baillie Gifford with its eye for talent, but also a significant player such as Tencent, which has over the years established a track record of intelligent and successful bets. The second major catalyst for the price increase over the last month or so was impressive delivery growth for the most recent quarter. In fact, during the month of June alone, it delivered over 3,700 vehicles, almost as much as the entirety of the first quarter, for a total of 10,331 vehicles throughout all of Q2. If the news about NIO's billion-dollar funding from Hefei City Construction and the line of banking credit was a rocket fuel, then the Q2 delivery numbers was a spark that ignited it. After almost 2 years as a publicly traded company, NIO has finally demonstrated the hypergrowth investors were so desperately seeking from the very start, at almost 300% year over year when compared to Q2 2019. While the company is yet to report Q2 earnings numbers, rest assured that if it demonstrates further declines to its net losses, ahead of even what analysts are predicting, the price action will surely continue its northward journey, which ties into my closing remarks and thoughts on NIO. In a previous video where I outlined my post-pandemic growth portfolio, which should be appearing as a card in the top right hand corner now if you're interested, I had already disclosed that I personally own a small stake in NIO as a speculative play. NIO remains a solid risk-reward punt in my opinion, but the downside needs to be stressed as well, since the company is still far away from profitability, and any potentially positive price action until such time will be purely based on the company's promise and not its bottom line. Its price to sales ratio currently sits at a very steep 10.5, which given that Tesla's already lofty valuation places it a touch above at 10.6, means that at the current price level, it is on par with Tesla dollar for dollar, despite a much worse track record. Regardless, given the uptick in deliveries and extra funding, it has a better shot now than ever before to increase sales, become profitable, and grow into a reasonably large player within the EV segment. The automotive industry is huge and diverse, and even if Tesla ultimately ends up on top within the EV segment, there's still an enormous share for other players. To put it in perspective, it is estimated that by 2030, the automotive industry will account for $9 trillion in revenues globally. And in a truly holistic sense, NIO and Tesla aren't even direct competitors, but rather allies in the war against manufacturers still producing internal combustion engine vehicles. One major advantage NIO has over other up-and-coming EV manufacturers that can't be stated enough is that it is already able to mass-produce vehicles. A player like Nikola, for example, with a market cap of 18 billion versus NIO's 13, does not even have working prototypes or the infrastructure in place to ramp up production and distribution. These are probably the most arduous parts of the journey from startup to established company, and the fact that NIO has managed to go through the growing pains and still be in its current position is a testament to its determination to succeed. Needless to say, I'm increasingly becoming more bullish on the stock as more news trickles out to the media. With a stable of broad appeal SUV vehicles, low price strategy to undercut competitors without skimping too much on quality, and potential to expand well beyond China after it has established itself as a trusted brand locally, there's a lot of promise here. While it is difficult to pinpoint a specific price target, it wouldn't be outlandish to think it could get to about 5 to 10% of Tesla's market value over time in the bullish case, since NIO only manufactures a very small cross-section of Tesla's overall product offerings. However, since Tesla's market cap is now roughly 280 billion as of recording, a 10% value would place NIO at around 28 billion market cap, indicating a potential 2x from current levels. If you're already a stockholder, then buckle up and enjoy the ride with me, since no matter how you spin it, NIO and essentially all EV stocks will be a volatile proposition to the very end, especially in the short term. If you're not a stockholder and are considering opening a position, I do think at the current price levels there is still tremendous upside, but there will almost certainly be opportunities in the future for entry as well, on pullbacks or even general market weakness. It would be up to you to decide if or when you want to pull the trigger. That about wraps it up for this video. What are your thoughts on NIO and its future potential? Post them down below in addition to any other questions or comments. Also, don't forget to hit the like button if you enjoyed this video, and even consider subscribing to really support the channel if you haven't done so. Before I go, click on the top video here to take a look at my analysis of Workhorse, another exciting EV manufacturer, or down here for a look at my entire growth portfolio for the post-pandemic era. As always, thanks for watching, and I'll see you in the next one.